Good morning, ladies and gentlemen, and welcome to this fifth episode of the Thinking with Cynthia webinar series. I hope you're all doing well. This morning's topic is quite a topical one. We have Sanveer Hariprasad, who is the head of fixed income at Cynthia Capital. He will be discussing preparing for the reflation trade. He will take us through what is reflation and how has Cynthia positioned its portfolios in preparation for this particular trade. If you have any questions, please make use of the Q&A tab at the bottom of your screen. We will then have a Q&A session right at the end of the presentation once Sanveer has completed. Please enjoy. Thank you. Over to you, Sanveer.
Okay, thank you for the introduction, Zama. So, as Zama said, I will be taking you through our views on this reflation trade and trying to prepare you for it. So basically what we're going to talk about today is trying to understand the reflation trade. Why is it important? Is there more reflation risk to come, and what can we expect? And then finally trying to position your funds and select asset classes to navigate through this difficult or tricky phase of the business cycle. So trying to understand the reflation trade. And before I go into detail on trying to define reflation, I'm just going to take a step back on how we actually got here. So back in 2019, when everything was moving along very, I would say, optimistically, I think, US GDP was at about 2 to 3%. China was growing at a steady 5 to 6% GDP. And then unfortunately, coming into February, March of 2020, we saw the COVID-19 crash, COVID-19 virus feeding through the markets. We saw the market crash there, the S&P 500 down 34%, the JSE All Share down 35%. And because of that, central banks had to step in massively with huge amount of stimulus. And that's what we saw happen towards the second half of last year, from April to December. Massive amount of stimulus, interest rate cuts in developed markets. Interest rates were cut into negative territory, in fact. And then towards the back end of last year, we had the vaccine rollout, the Democratic win there in the US that increased sentiment throughout markets. The S&P 500 rebounded from its low, up 72%, the JSE All Share up 66%. But then coming into the beginning of this year, in Q1, February, March, we had reflation concerns. And with that, rising bond yields. We saw US 10-year bond yields increase 70 basis points from 1% to about 1.7%. And then our local bond yields, 10-year bonds increased by about 100 basis points there. And going into 2021 and 2022, we're not sure what's going to happen. So that's why I'm going to take you through that, giving you our views on how we see the market for the next 2 to 3 years. So just defining reflation. What is it? It's basically the recovery in prices when it's fallen below its longer term trend. And it generally occurs when you increase, or central banks increase the money supply, or they reduce taxes to bring about growth so that it gets back to its longer term trend line, following a dip in the business cycle. And it's generally a necessary evil, because you need reflation to be able to close your out gap, to get your growth back towards its longer term trend line. And another way that you could think of it, or maybe I should show the graph first. The Fed, so these are the various price measures that the Fed looks at. So they look at headline inflation, they look at core CPI, your PCE, five-year inflation expectations. And you saw during the height of COVID last year, it dipped to very low levels, it's barely above positive, and then they rebounded sharply there to create this V-shaped recovery. And basically what this means, reflation, when you get back to your longer term trend, CPI on average was about 0% last year in the US. If you're trying to target 2%, which is what the Fed is trying to do, you need inflation of about 4% this year to get to that average 2% inflation. So that's why you need that bounce, so above trend, or reflation to actually come through the market to be able to achieve your longer term objectives. The side effect, obviously, with reflation is that it impacts bond yields. And if you decompose the bond yield, it's basically composed of your real risk-free yield, and then you add on top of that a risk premium. So your asset purchases or quantitative easing or stimulus, whichever word you want to use for it, that generally impacts these two variables. So your real risk-free yield and your risk premium. Now, with the amount of stimulus that the Fed's poured into the market, it's actually decreased these variables. So your real yields move much lower, and with that, your risk premium. The risk, obviously, with that is now, especially last night, you saw the Fed minutes saying that they're talking about taper tantrum risk. So taper tantrum is obviously when the Fed eases back on its asset purchase, so it purchases less. And because it purchases less, there's a risk that your real yield and your risk premium start to increase, which obviously increases your bond yield. The other two variables that impact the bond yield are your expected and unexpected inflation, and that's mainly controlled by monetary policy. So when the Fed saw inflation expectations falling drastically last year, what they did was they cut interest rates to very, very low levels because they wanted to get inflation coming back into the system. But that's obviously a risk later on, 2022, 2023, when they start to tighten, when they start to hike interest rates. So from Sentio's views and what we've been reading in the markets, we believe the Fed will be patient. They don't want a repeat episode of what happened in 2013. That's when the Fed started to taper assets a little bit too soon. You saw US bond yields rise by about 100 basis points. It created a risk-off sentiment in the market, and there was a bit of panic. So the Fed wants to be careful that they don't want to taper assets a little bit too soon now. So they would rather be cautious and stay patient. Unfortunately, the downside of this is that by staying patient, and the longer they stay patient, it's going to increase uncertainties throughout the market. And with that, you're going to get higher bond yields and steeper yield curves. Now, we know that the downside of having high bond yields and reflation risk is that it makes it difficult for companies to plan, invest, and engage into longer term contracts here, because they aren't sure what prices that they're going to lock into longer term. And because of this, it actually reduces your capital expenditure and also potential GDP and growth. It makes it extremely difficult for smaller companies as well to pass on these large input costs, because they don't have market dominance and power to be able to pass on higher costs, which means that they're going to take an impact to their margins and might even incur losses. And then finally, the most obvious one, higher bond yields mean that you're going to discount your dividends and future cash flows at a high yield, which means you're going to reduce equity prices, especially your longer duration assets or equities like your tech stocks. So that's the downside of reflation, in terms of that it impacts your bond yields or filters through into higher bond yields. Another way that you can look at reflation is if we plot simple demand and supply curves. So going back to economics 101, where you have your downward sloping demand line here, which is this red line, and then your upward supply curve. Generally, your equilibrium point would be at point A here, and that's what we found at the height of COVID last year. So we had quantity A of goods out in the market, and they were at a price of PA. With the massive amount of stimulus that the Fed introduced, sorry, just went back slightly. With the massive amount of stimulus that the Fed introduced in the markets, it shifted your demand curve to the right. So it increased demand there, which meant that your equilibrium point moved from A to B, which means there was an increased quantity of goods demanded now, but because of that, there was also an increase in prices. And then obviously, because of supply chains and constraints because of COVID, your supplies actually decreased throughout the market. So your supply curve shifted to the left, up to the left, which meant that the quantity of goods out there in the market was much lower. It was QC, whereas the quantity QB was actually demanded out there in the market, which meant that your prices increased even further. So this is what we mean when we say we have this reflation risk. But obviously, as we start to see the easing of lockdowns, further rollout of vaccines, we could see supply start to increase again, get back to normal levels, and you get your supply curve moving back from S2 to S1, which means that you would get your prices also moving down to their normal levels. And that's why at Cynthia, we believe this reflation trade is transitory. So it's very short term. Eventually, you'd start to see base effects come through and prices tend towards the longer term average. So taking on to the second part now, is there more reflation risk to come? Basically, if you look at academic papers that have done research on high inflation regimes, it's generally occurred during the ending of your wars. Also, if oil prices increase massively. If you look, I know it's a little bit busy here, but if you just focus on this blue block here, it's basically when inflation in the US was more than 5%. And it's generally your energy commodity, so your oil basically, that performed really well. Your oil was driving the high inflation regimes. So that's what we've seen so far. I mean, oil's increased massively over this last year by about 50–60%. So we still expect that to filter through. But on average, these high inflation regimes lasted for about 2 years. And so far, we've seen commodities increase quite to high levels for probably the last year, which means we can expect maybe another 6 to 12 months of high commodity prices coming through the markets here. Yeah, we're now speaking about oil prices. So if you look at energy inflation in the US CPI basket, it has a weight of about 6.9% there. Energy is increased by 25%, but if you look at the actual indices, it's increased much more than that, about 130%. So we can still expect a little bit more to filter through into your underlying prices. Companies have been passing on these higher costs. They won't be able to pass it on fully, so you'll see them starting to increase or passing through to the underlying consumers in a manageable fashion. And for instance, if you take 25% and you multiply it by that 6.9% weighting in the basket, it means that it's adding 1.7% inflation, which is quite high. And with this recent print you saw in the US there, where inflation was at about 4%, which is just above 4%. It's mainly on the back of energy prices coming through. But when things normalize, we believe that this is going to roll over as well. Another variable that we've been watching here, if you look at world trade volumes, you can see it's rebounded sharply, the V-shaped recovery. Unfortunately, with that, you've had an increased backlog. So when this moves up, it means that you've had an increased amount of backlog coming through the system. So you're not having supply being met with this demand, which has led to a reflationary risk of your higher prices coming through. Another sector, if you look at US housing, I mean, housing in the US has increased massively, 10% year on year, basically because of very low interest rates here, so spurring your first-time home buyers. There's also been a shortage of timber there in the US. I mean, timber prices have soared, which has increased house prices. And if you look at rental inflation, it's still quite low. That's the red line. So year on year, rental inflation in the US is still 1.8%. We believe that there's a chance that it's going to go up to 3%, which means it'll add another 0.5% onto your core inflation there. Housing is quite a big weighting in core CPI. You can see 40% weighting there. So it means for every percent increase there, it's going to add a lot. So we still have to wait for this housing price inflation to actually come through the system, which we can expect over the next 6 months. And then finally, with the amount of stimulus checks that the Fed's writing, the last one's $1,400 a month there to families. Consumers have built up this excess amount of savings there that they will eventually draw down. Personal income, you can see year on year has increased 15%, it's a massive amount. And this is going to increase demand and obviously price inflation coming through. But yeah, once again, base effects will cause us to roll over. Sorry. So we've seen all these shorter term impacts, increasing prices. One of the longer term factors that we believe that will bring prices back towards your normal or longer term average is your velocity of money. So this is a bit of a technical topic here, but I'll try to explain it as easily as I can. Basically, your velocity of money equation is given on the left here. So P is your price level, M is your money supply, V is your velocity of money, and Q is the quantity of your goods and services. So what we've seen is the Fed increased the money supply massively. I mean, I think year on year it's increased about 50% there. If you assume the quantity of goods and services remain the same and money supply increases, you could expect your price level to also increase. Unfortunately, what we've seen happen, and it's been happening over the last 30 years, is that your velocity of money has been going down, it's trending down. So this has, because this has been going down, money supply is increasing, it's actually limited the actual increase in prices. The prices have gone up, but not as much as you would expect. If you look at a graph, I mean, if you look at the gray line here, this is your velocity of money. You can see since about the mid-90s, it's been trending much low, even though you've had your money supply increase massively. So because of that, the underlying prices have increased, but not to the same extent. And one of the reasons why we believe that this happens, and this is going to continue where you have your low velocity of money, is because the amount of quantitative easing or stimulus that the Fed has embarked on it following the 1987 market crash, when Alan Greenspan was in power and he started to introduce the first amount of a stimulus coming through in about the mid-90s. And you can, if you basically index US household net worth, you can see it's actually outstripped your general GDP increase. And that's because of stimulus. So stimulus has basically increased asset prices, not generally consumer prices or prices in general. And that's generally benefited the ultra wealthy because they have a lot of their money in the stock market. So you can see here, since about the beginning of the 90s, the share of wealth held by the top 1% was about 21%. Now it's closer to 28%. So the ultra net worth have benefited from this. Now, the thing about the ultra net worth is they don't like to pay taxes. So what they do is they invest their surplus of savings into longer term projects. So it's tied up for a much longer period of time and they don't spend it versus your lower income earners. So that's why you've seen your velocity of money. So how much each dollar or rand moves throughout the system. It's been trending down because of the asset price inflation and stimulus. So that's one of the longer term views that we have, that your velocity of money is going to stay low and it's going to keep a cap or lid on prices. So that was a bit of a technical longer term view that we have there, but I hope I explained it. And then another variable that we're watching is if you look at US real yields, we have the view that those will remain low and it'll support your risk assets, especially if you're going to move into a high inflation regime here. You'll see demand for real assets like your tips, so it's going to keep your real yields low. Another variable that the Fed has mentioned is if you look at the labor market there in the US, unemployment rate pre-COVID was quite low. It was below 4%. Currently, it's sitting at 6% here, and the Fed will only begin to taper or hike interest rates once they see this unemployment trending back towards this pre-COVID level of 4%. So we'll have to watch this when it dips to below 5%. I think you start to worry that the Fed is going to start tapering soon. And then one of the last variables that we're watching here is if you look at your US 10-year term premium. Basically, your term premium you can think of as the compensation that you should get for locking up your money for a long period of time. So because of the amount of stimulus that the Fed has introduced in the market, it's actually decreased the term premium into negative territory here, which means you're not really getting compensated for holding your cash for longer term. And if you look at pre-COVID, that was sitting at about negative 50 basis points. Well, now the market's repriced basically, and it's sitting at negative 20 points. So this tells us that the market's priced in too much reflation risk during this near-term phase, and we can expect a bit of risk on into Q2 and a little bit of Q3, and markets mainly going to remain sideways, and it'll be a bit of a Goldilocks scenario where everything is going to be doing well. So it's a very short time frame until we start to see a bit of taper risk or taper tantrum coming through towards the end of this year. So to summarize everything, we believe reflation will be transitory. We can have base effect coming through. There's going to be supply chain constraints, which means you're going to have increased input costs. We've seen it already with timber and semiconductors. Because of the labor supply as well, I mean, a lot of people are still dependent on those stimulus checks. They're not going to work, so your actual pool of labor is much smaller now, which is going to add to higher wage costs. And then we had increased vaccine rollout and reduced lockdowns, which is going to increase consumer and investor activity, spur demand, and also prices. But we believe that this will be short-lived. It'll roll over in the next 6 to 12 months, and then your longer-term deflation and disinflation effects will dominate. So you have longer-term demographics coming through. You have older people spending less. You'll have a switch from onshoring to offshoring. So increased supply from China and your low producing countries, which will reduce input costs overall. Increased labor supply. So as the stimulus checks in, people will be forced to go back to work, which means that your labor pool will increase, which will obviously reduce wage costs. Governments have borrowed massively during this phase here, and they can't afford debt servicing costs to rise too much or interest rates to rise too much. So naturally, they would want to limit that. And also, you've had tech advances coming through, which means that you have increased automation efficiency, which will reduce costs. And then finally, the last point that I made mention was you're going to have a low velocity of money, which is going to keep a lid on prices. So this will be a longer term structural effects that will keep prices low. So you won't see those huge spikes like you saw back in the 70s and 80s. Finally, positioning for this reflation trade and trying to select asset classes that are going to perform well. So at the moment at Sentio in Q2 and about Q3, we believe that the first phase of reflation risk has been priced in. The US 10-year is going to remain range bound there between 1.5 or 1.5 and 1.8%. We'll see a weaker US dollar, which will be positive for risk assets. Then once you move on to the second half of 2021, and we believe maybe the back end of this year, you're going to have your inflation spike here. That's when the Fed's going to start talking up taper tantrum. US inflation is going to be quite high, between 3 and 4%. The US is probably going to be about, or the US 10-year is going to be about 2% there. And then you can have your reflation and taper fears coming through, which will be positive for the US dollar, negative for your risk assets. Following that, you're going to have a period when assets are going to be oversold, they're going to be cheap, so you want to increase your risk. The dollar will be weaker there. Growth outside of the US will be very strong. So in this phase, you probably want to buy up those cheaper assets. You want to take on a little bit more risk. And then following that, towards the end of 2022, when the Fed starts to eventually hike interest rates, the dollar is once again going to dominate. It's going to be strong. So you want to take a risk off during that phase there, where the US 10 is probably going to be in the region of about 2.5 to 3% there. And then following that, a similar scenario in 2023, once you're going to get your oversold assets, the markets will, or there'll be very cheap assets out there, and you want to be stepping in and purchasing that. So increasing your risk premium, increasing your tolerance there as well. And then inflation is probably going to head back towards that longer term target, or the Fed's target of 1.5 to 2% there. The risk obviously is if we have some fiscal issues in terms of trying to keep the public sector wage increases very low there. If we have more severe COVID strains resulting in stricter lockdowns, or vaccine rollouts are going to be much slower than everybody is actually anticipating there, or inflation, or the Fed will be a little bit slow in terms of tapering assets or hiking interest rates, and you end up getting out of control inflation there. We believe that those are tail risks, and we'll be watching and monitoring those very closely. In that, we also have quite a bit of machine learning, which tries to identify regime switching. So we look at underlying variables to identify early signals in terms of trying to identify this risk on, risk off phases. And then in terms of your asset classes going through this period, so it's a bit of a busy chart here, but basically at the moment, the way that we position in our funds, we overweight domestic assets, so let's say equities and bonds, overweight duration here, and then overweight your value over growth, and then your quality of your lower risk, and then we underweight offshore, so underweight offshore equities, and then underweight offshore bonds as well, because we believe developed market bond yields are rising. Then once you go into your inflation spike or your taper tantrum risk, so you want to be taking risk off, you want to be overweight your safer assets such as your developed market bonds here, but you want to be underweight everything else here. And then once the assets are oversold, you want to be taking on risk. So you want to be naturally overweight your SA equities and bonds, underweight developed market bonds, and neutral offshore equities here. It's basically neutral there because you believe that the dollar is going to be weaker there. And then similarly, going into your US hikes, you want to take a risk off. So similar asset allocation to what you had during the taper tantrum. And then once the asset sold off, you're going to be taking on risk like you did here following the taper tantrum risk, where you want to be overweight your SA equities and bonds, and then you underweight developed market bonds. Okay. Thank you. Any questions?
Thank you, Sanvia, for your presentation. Maybe just a question around your positioning as a fixed income manager. We've seen in the past 12 months or so, particularly in the multi-asset income CISA category, tremendous flows going into that part of the unit trust industry. And I suppose it's been a search for better returns because most investors have not been compensated for the additional risk that they've taken by investing in other more risky multi-asset and even general equity portfolios. With the recent recovery that we've seen in the equity space, what would your advice be, firstly, in terms of positioning clients that are placing new money into these fixed income portfolios? I mean, looking at the returns of the past 12 months, we've seen some of these income funds generate returns that have beaten cash by maybe as much as 5% or so. Obviously, that is not a sustainable return. If you can just maybe unpack your thinking around positioning in an income portfolio, particularly unpacking the types of bonds, duration, and positioning on the bond curve. Thank you.
Yeah, sure. Okay, so I'll start with the bonds. Basically, if you look at emerging market local currency bond yields, there's still a bit of value left that they haven't rallied as much as your hard currency or your US dollar bonds. So we believe that there's still a bit of value there. Like I mentioned, being a Goldilocks phase here where we think a lot of reflation risk has been priced into the market here. So you want to be taking on a bit more risk here. The time frame is obviously quite short here. It's probably going to be another 3 or 4 months until you start to see the market fears increase and the Fed start talking about taper tantrum, where you want to reduce risk there. So at the moment, we believe in the short term, you're quite tactical. You'd still want to be taking on a bit of risk. You don't want to be reducing risk at this stage. There's still a bit of upside left in SA equities and SA bonds. Offshore equities, there is still some upside left there, but we believe the US has run very hard there. If you look at equity markets globally, and if you index them, so you index the US equity market versus ex-US, you can see that ex-US has actually underperformed relative to the US market. So we believe that maybe you don't want to be investing in offshore equities as yet. And then obviously with your offshore bonds, we believe that the reflation risk is still to come, and you're going to have higher developed market bond yields there. So you naturally want to be underweight that. So at the moment, we believe that you should be positioned like how you are at, or how we are essentially at the moment. So you want to be taking on risk. Yeah, so you don't want to be taking on as much risk as you was probably about a year ago when assets were deeply discounted. They were extremely cheap, but you do want to be increasing your risk spectrum a little bit above your neutral level. It's not like maximum overweight risk, but you still want to be taking on a little bit of risk.
All right, thank you very much. Thank you very much, ladies and gentlemen, for joining this session. I hope you all enjoyed it. We will be sending through a link with the recording if you would like to listen to it again. And thank you so much for attending. And Cynthia, thank you for your time. And we wish you a lovely day further. We'll see you next time. Bye.
Okay, thanks, guys. Cheers.